Tesla Inc. is currently trading at $217.80 a share, down almost 9% after the market reacted pretty poorly to the CyberCab event. This event almost wiped $67 billion from the car maker's valuation. What we're going to be doing is talking about the event and then looking at my automated stock valuation spreadsheet to see if this is the right time to buy Tesla, looking at the discounted free cash flow model, the comparable company model, and of course the Ben Graham formula for intrinsic value. So as I said, they had their CyberCab event and it wiped about 67 billion off it. This was the robo-taxi event. They're now called the CyberCabs. And it is, yes, the largest company or the largest car company in the world with a market cap of around about 700 billion. But these CyberCabs that would be available for less than $30,000 and ready for 2026, people did not like what they saw. So let's have a look at my spreadsheet. Firstly, if we put in the ticker Tesla, TSLA, it will load all the latest company financial data, and then we can have a deeper dive into the stock. As I said, $217 a share, 860 billion market cap, a PE of 61, so trading at a premium, with the market average being around 30. $3.56 in terms of earnings per share. Very, very high beta, one of the highest we've seen. $2.29, meaning it is a very, very volatile stock, and a target price of 210. So according to analysts, slightly overvalued. Now let's have a look at revenues. Revenues have consistently growing, currently 95 billion, not all-time highs, with the all-time highs of 96.77, but you can see here that the revenue has grown exponentially, though slowed down in those 22-23 years, and looking like it is actually down slightly in 2024. Net income, they are a very profitable company now. That was the issue with Tesla for a long time until 2020, but similar story on the revenues, 12.4 billion, down from 2023. Free cash flow, they are generating free cash flow, but that is even down once again, 1.72 billion, down from prior highs of 4.3 and 7.5. So what I want to do is actually look at the operating cash flow and the CapEx. So we have operating cash flow here in blue, CapEx in red, and then the remaining free cash flow in green. So what we can see here is, yes, operating cash flow has increased up until 2022. CapEx has steadily increased as well, but operating cash flow is down, which is not what we want to see. Yes, they can spend more on CapEx, but we would like to see operational cash flow still growing. So that is not good. Shares, they actually issue more shares. Now this doesn't show it exactly because of splits and things, but you can see they have steadily issued shares, and it's split, and then split again, and they're still issuing more shares. Now if we look at the stock price over the last 5 years, back when they're issuing shares up here and at these highs, good idea. So now the stock has dropped a bit when they were issuing shares around about that 21-22 period when the stock was almost $400 a share. That's worked out pretty nicely for them. So let's have a look at the discounted free cash flow model. This is a way of valuing companies, looking at their future free cash flows and discounting them to today's value. $9 a share is what it's giving us currently. Let's have a deeper look at the numbers here and see. Revenue, we're estimating 112 and 130 billion in the coming years. Let's see if that is close to what analysts are saying. Analysts, a lot less. That's even on the high side. So we're being bullish here. We'll keep those numbers the same. Over the next 5 years, they're expecting around about 1.4% growth. My word, shocking realistically. So fine, we'll keep revenue growth rate the same. Net income margins, I'll increase these. Let's bring these up to 15. That puts us at a $12 stock. And free cash flow to net income, if we take the averages, we'll say 20%. $16 a share. So discounted free cash flow does not like the stock. We'll quickly look at the Ben Graham formula for intrinsic value. This is looking at the earnings per share, PE of a non-growth company, and the expected growth rate. And we did see actually the expected growth rate was very, very low, much lower than I was expecting, which is quite surprising actually. Let's see here. Yeah, 1%. We'll say 2%. Very low, $35 a share. Now, if it was to be able to grow at the last period, which it did over the last 5 years, which was around about 50%, it would still be slightly overvalued, sorry, according to this formula. So, discounted free cash flow does not like the stock. Ben Graham does not like the stock either. So finally, we will look at the comparable company model. This is a way of valuing companies, looking at similar companies of similar sizes, metrics. We'll be looking at revenue, 5-year growth rate, net income, profit margins, PEG, EV to revenue, EV to EBITDA, P, and also I've added forward P in here. So I would like to add in Toyota, but I can't because of the way the sheet works. I will add that in soon. We're going to look at some car companies first, do sort of a direct comparison here. If I look at top US car companies by market cap, can't spell on my other screen. We would have, so GM and Ford. Also, what we'll do is compare sort of stocks in the top 10 as well after this. So what we'll do is we'll just compare the GM and Ford specifically. Oops, sorry. Let's go to here. And what do we want is another one. We will look at VW. Can we look at VW here? Oh, sorry. TM actually, Toyota. Let's see if we can actually add Toyota. Toyota share price. The ticket is probably TM. TYT. What is it in the New York? TM. Damn it. So we'll just gloss over the revenue numbers here because this is in Japanese yen. But enterprise value, Tesla bigger than all those. Revenue not as high as Ford and Toyota. Let me just quickly get up the yen to USD. Oh, it's about $1 USD in yen. Apologies for this. So times 150. I'm not going to do that maths on the top of my head. Growth rate, Tesla is the highest growing, yes. Toyota 8% though, very good. Net income, profit margins a little bit higher than Toyota, 11%, 6.2 and 13. Price to sales, price to book, PEG, we're looking for 1 and under, which the Peter Lynch's price to earnings growth. Only Ford and Ford is there. Toyota pretty close. EV to revenue, EV to EBITDA, PE. Basically, it's a $80 stock if we look at averages of these companies. Quite interesting to see there. So what I want to do is actually just compare it versus some of its fellow constituents in the top 10, and we'll look at some of the growing ones. We'll go NVIDIA. Obviously, this is not really how you would use a comparable company model, but I do want to compare it just to sort of the top 3, which is Apple, NVIDIA, and Microsoft. Now, obviously, a lot of investors are expecting Tesla to be in this in this range, which is why I think it is a fair comparison. So does have a buy price of 240. This is because of the EV to revenue numbers. EV to EBITDA, P and forward P, it is still not a buy at around about 180. 170 if we take averages of them. But with the EV to revenue, it is actually a buy, interestingly enough. Growth rate, second highest growth rate only to Tesla. NVIDIA. Profit margins, lowest of the profit margins here. The tech companies, 26 and 36. NVIDIA with a massive 55% profit margin. That's absolutely crazy. PEG, it is the highest as well. Forward PE, highest. Current PE, even higher than NVIDIA, which I think is very telling. Only the EV to revenue it does like here. So interestingly, maybe a buy if we compare it to its comparison, compared to the top companies, but I think this is pretty close. Does not look a buy right now, despite, well, as you can see, the comparable company model didn't like it compared to car companies. Maybe likes to compare it to NVIDIA, but that's a bit of an extreme. Ben Graham does not like it either. And of course, the discounted free cash flow, almost hated it. Right, guys, thanks for watching. Sorry, it was a bit rambly in the middle there. I'll try and tidy that up in the next video. Check out my Patreon if you're interested, and I'll catch you guys next time.